Hello everyone, and welcome to today's presentation. I'm excited to have you here as we explore the fascinating world of market analysis. The focus of our session is on understanding support, resistance, and market sentiment. We'll also look into NIFTY open interest analysis to see how it all ties together. Over the next few slides, we'll uncover how these concepts help us make better trading decisions. So let's get started. Open interest, or OI, refers to the total number of active options contracts that haven't yet been closed. In other words, it represents the current level of market activity and how much participation there is in a particular options series. Traders pay close attention to open interest because it helps them understand how many market players are involved at any given time. When open interest is rising, it often indicates that new money is flowing into the market and that more participants are taking positions. Conversely, if open interest is decreasing, it could suggest that traders are closing out their positions, possibly signaling a shift in market sentiment. This measure is also useful for identifying support and resistance levels. Significant changes in open interest at certain price points can hint at where traders expect the market to find support or resistance based on where the most contracts are held. And finally, open interest provides insights into the overall mood of the market, whether traders are feeling bullish or bearish. An increase in open interest along with rising prices might suggest strong bullish sentiment, while an increase with falling prices could indicate bearish outlooks. Overall, understanding open interest is a key part of gauging market participation and sentiment, making it a vital tool for anyone looking to interpret options markets effectively. Let's take a look at the current market situation. The NIFTY is approximately at 24,006. This gives us a good reference point for understanding the options landscape. Now, the at-the-money, or ATM, strike is around 24,000, which is very close to the current NIFTY level. When we talk about options, the position relative to the ATM strike tells us a lot. To the left of ATM, that is, below 24,000, we generally see ITM puts and OTM calls. These are options that are either in the money on the put side or out of the money on the call side. Conversely, to the right of ATM, above 24,000, we find OTM puts and ITM calls. Understanding this distribution helps us gauge the market's sentiment and potential support or resistance levels. It also gives us insight into the overall market positioning, whether traders are leaning bullish or bearish. By analyzing where the current NIFTY stands in relation to these options, we can better anticipate possible movements and strategize accordingly. Now, let's take a look at the highest call open interest levels, which actually indicate potential resistance points in the market. When we see high levels of open interest at certain strike prices, it suggests that many traders have sold call options at those levels, expecting the market to stay below them. Specifically, the key resistance levels here are 24,200, 24,300, and 24,500. These are the points where the most call options are open, meaning there's a lot of activity and interest around these prices. What this really tells us is that option sellers are betting that the market won't go beyond these levels. They're essentially setting a sort of ceiling, anticipating that the price will stay below these points. Understanding these resistance levels is crucial because they help us gauge where the market might face hurdles. They also reflect the collective sentiment of traders who believe the market won't break through these levels easily. So, by keeping an eye on these open interest levels, we gain insight into potential resistance zones and overall market sentiment, which can be very useful for our trading strategies and risk management. Now let's take a look at slide 5. Here, we're focusing on the highest put open interest levels, which actually indicate support levels in the market. Essentially, when we see high put OI at certain price points, it suggests that traders are expecting the market to find a floor around those levels. The key support levels to watch are 23,950 and 24,000, 23,800, and 23,450. These are the price points where the most put contracts are open, meaning a lot of traders are defending these levels. What this tells us is that buyers are actively stepping in to protect these zones, preventing the market from falling further. It's a sign of strong support, and understanding these levels helps us gauge potential bounce points or areas where the market might stabilize. So, keeping an eye on these support levels, especially the ones with the highest open interest, can give us an edge in predicting possible market movements and making more informed trading decisions. Let's take a closer look at this slide. The striped bars here indicate changes in open interest, which is a crucial indicator for us. When we see an increase in call open interest around the 24,150 to 24,250 level, it suggests that traders are expecting resistance to hold at these levels. This means that many are betting on the price struggling to move above this range. On the other hand, there's a noticeable increase in put open interest near 23,950, which signals that strong support is forming there. Traders seem to be positioning themselves for the price to stay above this level, adding a layer of confidence in the support zone. All these signals point towards significant buildup in open interest at these key levels. It's important because such increases often precede potential price reversals or consolidations. So, recognizing where traders are amassing positions helps us gauge possible future market moves, aligning well with our overall theme of understanding market sentiment through open interest dynamics. Based on the OI data, we're looking at an expected trading range between 23,950 and 24,300. This means that, given the current open interest and market activity, we anticipate the price to stay within these levels in the near term. Now, when it comes to breakout signals, there are a couple of key levels to watch. If the price moves above 24,300, that's a clear bullish breakout signal, indicating potential upward momentum. Conversely, if the price drops below 23,950, it suggests a bearish move, possibly leading to further decline. These breakout points are crucial because they help us identify potential trend shifts early on. The overall idea here is to use these ranges and signals to gauge market direction and make informed trading decisions. Remember, these ranges are based on current data, so staying alert for breakouts can give us a strategic edge. Let's take a closer look at the maximum OI levels. When we talk about max call open interest, it generally acts as a resistance level. That means, as the open interest for calls peaks, the price often finds it hard to break above that point. Conversely, the max put OI tends to serve as a support level, providing a sort of floor where the price might find it difficult to fall below. Market makers are quite strategic here. They often try to keep the price hovering around the max pain zone, which is where the maximum number of options expire worthless, minimizing their losses. This is a key trick used by professional traders. Understanding where these maximum OI levels are can give you a significant advantage. It helps you anticipate potential resistance and support zones and understand the market's natural tendencies. By keeping an eye on these levels, you can better position yourself and avoid getting caught off guard by sudden moves. Remember, the market often gravitates toward these points because of the collective behavior of traders and market makers. All right, let's look at the support and resistance levels to give us a clearer picture of the current market situation. The support levels are at 23,950 and 23,800. These are the price points where we might see buying interest strong enough to prevent the price from falling further. On the flip side, the resistance levels are at 24,200 and 24,300, which are the areas where selling pressure could cap any upward movement. Now, considering the overall market bias, it's slightly bullish. This suggests a cautious optimism, meaning that while the trend is leaning toward upward movement, we should still be vigilant for signs of reversal or consolidation. An important takeaway here is that combining open interest data with price action analysis can significantly enhance our trading decisions. Open interest tells us about the market's participation and potential strength behind price moves, while price action reveals the immediate buying and selling behavior. So, in conclusion, always remember to look at these levels together. Support and resistance give us key zones to watch, but pairing that with open interest and price movement gives us a more comprehensive view. This integrated approach helps us make more informed, confident trading choices in line with the overall market trend. Let's take a closer look at this NIFTY OI chart example. As you can see, this chart provides valuable insights into market sentiment and potential future movements. The key points here are how open interest levels, combined with price action, can signal whether traders are building positions or closing them. For instance, increasing open interest along with rising prices often indicates a strong bullish trend, while decreasing open interest might suggest a lack of conviction. Connecting this to our overall theme, understanding OI movements helps us make more informed decisions and manage risk effectively. So, always remember to analyze OI in conjunction with price action for a clearer market picture.